In 1933, the US government enacted an extraordinary measure. It became a federal crime for a private citizen to simply possess gold, not to trade it or hoard it, but to merely own it. Anyone caught with gold coins, bullion, or certificates after the deadline faced a staggering fine of $10,000, equivalent to hundreds of thousands today, and the possibility of a decade in prison. Overnight, Americans were compelled to surrender their most timeless store of value, trading it for paper dollars at the government's command. Imagine being informed that the very money you trusted, the wealth you had meticulously saved, and the assets passed down for generations were suddenly illegal to hold. This was not the work of criminals. It was a law signed by the highest authority in the nation, and it would irrevocably alter the course of the financial system. To comprehend how such a radical event could occur, we must revisit one of the bleakest periods in American economic history, the Great Depression. By 1933, the country was devastated. A quarter of the workforce was unemployed, factories were shuttered, thousands of banks had failed, and ordinary citizens were losing everything they had. The banking system was crumbling as depositors, losing faith, rushed to withdraw physical gold. At the time, the dollar was on the gold standard, meaning every paper dollar was theoretically redeemable for a fixed quantity of gold, $20.67 per ounce. This bank run on gold was draining reserves and pushing the entire financial infrastructure to the brink of total failure. Into this crisis stepped Franklin Delano Roosevelt. Inaugurated in March 1933, he inherited an economy in a nosedive. He needed a drastic solution to halt the widespread panic, and it arrived less than a month later. On April 5, 1933, Roosevelt issued Executive Order 6102. This order outlawed the private ownership of most forms of gold. Citizens were given until the end of the month to hand over their gold to the Federal Reserve in exchange for paper currency at the official rate of $20.67 per ounce. The official justification was to stabilize the banks, prevent hoarding, and empower the Federal Reserve to expand the money supply. In practice, this action represented one of the most significant forced transfers of wealth in modern times. Under threat of severe punishment, Americans lined up to turn in their coins, bars, and family heirlooms. While some chose to resist by hiding or burying their gold, the majority complied, fearing the harsh legal consequences. But here is the most painful part of the story. After collecting the nation's gold, the government didn't merely store it. In January 1934, through the Gold Reserve Act, it revalued gold to $35 per ounce. With this single legislative action, the dollar was devalued by nearly 40%. The government had confiscated gold from its citizens at the lower price, only to immediately declare it was worth significantly more. The people had surrendered their wealth, and the government instantly reaped the profit. This was no minor adjustment. It was a fundamental rewriting of the rules of money. By seizing private gold and devaluing the dollar, the Roosevelt administration granted itself the authority to inflate the currency far beyond the limits of the old gold standard. This enabled massive government spending, increased borrowing, and the launch of the ambitious New Deal programs. For the banks, it was a lifeline, restoring confidence in the financial system. For the government, it was a power grab. But for the average American, it was an act of theft legitimized by law. Consider this on a personal level. Imagine your ancestors had diligently saved gold coins for their entire lives. Suddenly, the government outlaws their savings, forces them to exchange it at a set price, and then immediately increases the value of that very same asset. Your family's wealth is diminished while the government's grows, and you are powerless to stop it. This isn't a hypothetical. It's precisely what happened to millions in 1933. The decision was highly contentious. Lawsuits, known as the Gold Clause cases, eventually reached the Supreme Court. Many contracts of that era included gold clauses, which stipulated that debts must be repaid in gold value, not paper money, as a safeguard against inflation. The government's actions had rendered these private contracts null and void. In 1935, in a narrow 5-4 decision, the Supreme Court upheld Roosevelt's authority. This ruling established a disturbing precedent. During a crisis, the government could unilaterally change the rules of money, override private agreements, and seize wealth for the national interest. The deeper truth is that this was about dismantling the gold standard itself. By removing gold from public hands, Roosevelt severed the direct connection between citizens and hard currency. Paper dollars, backed only by government decree, became the sole legal tender. The financial system had transitioned into a new age where faith in gold was replaced by faith in authority. So, who were the real winners? First and foremost, the government. By confiscating and revaluing gold, Washington increased its reserves by billions, enabling it to finance the New Deal and stabilize the economy without imposing crippling taxes during a depression. It was a brilliant feat of financial engineering, but a profound violation of private property rights. The banks also benefited, as the gold consolidated in Federal Reserve vaults restored stability to the fractured banking sector. The very institutions whose failures had harmed depositors were bailed out at the expense of the public. Meanwhile, the wealthy and politically connected often found ways around the rules, moving gold overseas or converting it into exempt assets like rare coins. Ordinary citizens had no such recourse. The ultimate result was an upward transfer of wealth from households to the state and its allies. The losers were the millions of Americans who had trusted in gold as a tangible store of value, only to see their security confiscated and devalued overnight. They learned a harsh lesson. The rules of money are not immutable. They can be rewritten by those in power. This history matters today because the underlying principle persists. When the system is under threat, governments will take extraordinary measures to preserve it, often at the expense of citizens' wealth. In 1933, it was gold. In 2008, it was taxpayer-funded bailouts for banks. In 2013, Cyprus executed bail-ins, seizing portions of bank deposits. Today, inflation acts as a stealth confiscation. As your savings buy less each year, wealth is silently transferred from you to the system. The lesson of 1933 is clear. Do not assume your wealth is sacrosanct, or that the system will always adhere to its own rules. The precedent has been set. True financial security lies in assets and knowledge that are resilient to sudden policy changes, skills that cannot be taken, hard assets that endure when paper promises fail, and a keen awareness of history. When America took its citizens' gold, it was presented as a patriotic rescue, but the outcome was undeniable. The system was saved, and the people paid the price. History whispers a timeless warning. If they could take your wealth once, they can do it again.